last year, India saw about $113 billion of M&A activity, which was 40% growth as compared to the previous year. In the same context, there was a 10% dip in private equity activity in India. And I think the overall color of the capital is changing from venture capital to more IPO, but not necessarily available to everyone. Strategic capital is becoming far more prominently available. And I think one of the points that get debated again and again is there a stress in the system, or this indicates maturity, evolving maturity of the ecosystem? So maybe we can start with that. Would love to hear your views. That is there a stress, or this is evolving maturity?
As I would think, it is definitely, I believe, an evolving ecosystem. Every evolution goes through stress, and such stress definitely accelerates the evolution. So we are in an evolution stage. If we look at some of the developing economies in the US, Europe, or even some parts of Asia and Japan, business consolidation is a natural phase of an operating business cycle. So consolidation seems quite natural over there. So let's take an example where we stand in India. If we look back in the early years, the focus was predominantly on formation of companies, formation of entities. Then there is a phase whereby we see that there are many players, there is plenty of capital, there is rapid growth. Eventually, the market starts asking some different questions, like which entities have profit? Where can they build up a sustained governance infrastructure? Where should be the market? Where is the focus right now? And I believe India is in such phase now. This is a consolidation phase, no doubt, but that would not mean there is weakness. It should be considered. There was a time whereby exits were considered as a failure. Success of a startup was considered only on two grounds. Is it a unicorn? And is it going public? But the definition of success seems to be changing now. Today, if we look at market players, whereby if they are acquired, and so that they can be part of a bigger network, which can allow their people, product to be part of a bigger scale, bigger platform, bigger market cycle, I think they consider that as a successful exit. So in my view, we are in an evolution of an ecosystem rather than just a stress.
Hi, everyone. I'm Priyanka. I'm not sure if I know the mics were very, very low, but I hope people at the back can hear me. I come from a very different world. I have an extensive practice in entertainment, and my day job involves working with a lot of talent, actors, social media creators, comedians, filmmakers, a lot of artists in the music industry, and generally stakeholders that look at the entertainment ecosystem. And the reason I bring this up is today we're seeing in the last couple of years extensive consolidation and M&A activity in entertainment. And when I say entertainment, I'm speaking more broadly across sports, gaming, a bunch of consumer brands that are all celebrity-led, celebrity-founded today. And I think what Amit here said is sort of true, right? We are evolving. We're seeing a lot of interesting consolidation. I don't think the dream anymore is, okay, I just want to either see an exit or build another unicorn. I think it's also the journey that's starting to become more and more meaningful. So I think it'll be interesting to see how much the sector grows, which direction we're headed in the years to come.
Thank you so much, Priyanka. Follow-up question to that is, when you see entrepreneur-driven businesses interacting with large corporates, what are the fundamental challenges that you see in their approaches?
I see a lot of them because I usually end up acting for a lot of creative talent or creative founders. In fact, just a couple of days ago, we announced one of the other transactions that we were on where Nikhil Kamat's company WTF acquired a creative agency called By the Gram. And we ended up representing BTG as well as each of the 3 female founders. And I think in my experience, and this is not specific to this particular transaction that I'm quoting, but I think there's a lot of challenges sometimes in communication between founders and investors, especially in the sector that I interact with. The challenges can range from all sorts of things, right? Usual fights over reserve matters. Am I ready to, do I just want a big secondary? And I think that's the big sort of challenge that I see increasingly when I'm working with founders as clients. I think everyone's just become so obsessed with that glossy headline and seeing what some other founder has seen as their exit, that everyone's chasing that big secondary without understanding that, hey, listen, I still need to have skin in the game. It's too early for me to start thinking that, okay, this is the race that's going to completely change the course of my life. And I think it comes down to me repeatedly needing to have very honest, candid conversations with clients that I'm working with, saying, why are you raising a round today? What is the purpose? Is it for capital? Is it for personal ambition? Are you fatigued and you just want to cash out? Just be honest and upfront about that. So then that's an interesting starting point, and you work backwards and see how do you evaluate. So I think that's one of the quirkiness that I come across in my experience, at least doing M&A in the entertainment ecosystem.
Understood. Thank you. Amit, we always keep talking about the outcomes of M&As are not defined by what you do during those periods, right? The seed get sown much before that. So in terms of typical issues or mistakes that you see entrepreneurs end up in making, which come back to bite them during these processes?
Sure. So if I look back and see more than 2 decades of my experience in cross-border transactions, we have hardly seen any transaction getting derailed because of higher tax, or the tax computation is quite complex. There are reasons. If I have to classify them, there could be broadly 3 reasons which can create either a delay in the transaction, or they get more expensive, or at times the transaction is killed. If those 3 reasons, if I have to point out, the first one could be that unexpected tax costs, if I have to word it properly. So we started with a tax cost of $10 million, but when we read the fine print, the tax cost comes to $80 million. Or at times, even post-acquisition, the tax cost becomes quite high once we read the fine print and they come to know about it. Because post-acquisition, there can be consolidation of subsidiaries, there can be movement of IPs, etc. So the tax attributes which were thought of while the valuation was done in a transaction, they may no more be valid. Just to give you an example, I have been recently working on a transaction, very high value transaction. The transaction was to acquire 51% as a joint venture in an Indian entity. And suddenly they thought that they have attributed a huge value to the tax losses in the Indian entity, which cannot be taken, and the benefits of that cannot be taken once the 51% shareholding moves. So this unexpected tax cost is the first attribute which definitely derails a transaction. The second thing which I could think of is tax uncertainty. Whether tax treaty benefit will be available, whether historical tax exposures are going to bite us. Can there be, we saw a Tiger Global ruling whereby there was a multi-million-dollar demand now hanging on their head because of the Flipkart thing. So these uncertainties create a lot of nervousness. And the last thing which we have seen and practically observed is that the tax risk allocation at times is unclear. Who is going to bear the risk? The seller? The buyer? Will there be an indemnity? Will there be an escrow? Should we adjust the price? How do we take care of it? So these are predominantly the factors. But now, how do we take care of them? There is no rocket science on how to take care of them. There are certain basic universal rules which revolves around it. The first thing which definitely as a consultant which comes to my mind is a good diligence. A good diligence definitely saves a transaction. Diligence does not mean that the risks will be mitigated. Diligence means that the risks will be identified and you can price your transaction accordingly. The second thing which, being a consultant, I must not be speaking so candidly, but I would rather say that is that you should always ask for a clear and opinion-based views from the consultant. Complex cross-border transactions have multiple legal outcomes, but none of the founders or management is interested in a 50-page note with legal views, options which are not clear. The risks are not quantified. So please ask for them. And lastly, if I have to say this is, please, there are options now to get tax and regulatory insurance. Opt for it wherever it is feasible. It will help you bridge the gap of the uncertain outcomes. So to summarize, Ashish, I would say start early. Don't start when the buyer is knocking at your door. If you start early, the consultant may give you many choices. Otherwise, the choices will be limited.
Priyanka, in your opinion, from an entrepreneur's perspective, there are always two choices. Is it better? So from in your experience, from an entrepreneur's perspective, there are always two choices, right? Keep raising capital and probably acquire to accelerate the growth. Second is to become part of a larger platform. Either sell full, sell partly. Especially high growth businesses, it is preferred that the founding team continues to run the business for a certain period of time. Whatever you have seen with your clients, what are the factors that determine or influence these choices in their mind?
That's a very interesting question, Ashish. I think I see both categories from where I'm sitting at. Many a times founders or younger businesses that opt for an acquisition or want to be a part of a larger organized setup, I think is because they're always looking for an interesting strategic partner that's relevant in the market that they're operating in. It means that they get to tap into somebody else's existing ecosystem, infrastructure. Very often there's knowledge sharing, right? Instead of me having to learn on the job or through my experience, that's going to at times be time intensive and also sometimes costly. It's easier for me to be a part of a larger strategic ecosystem and learn. And I'll give a simple example, right? Very routinely, you'll have, again, in the entertainment business, studios, production companies that end up acquiring a lot of smaller businesses that are rendering production services or creative services, marketing, things like that. And or I'll see artist-led businesses or brands that then get acquired into a larger ecosystem. It's just purely the decision there is, hey, I get to participate in a larger setup. I'm hopefully going to get the right advice, the right guidance. I'll have more resources, more tools at my disposal. So that's one of the big reasons that I see a lot of young founders of the business and young companies opt into strategic buyouts. The other kind that I see is founders who are confident of what they're building, but I think it completely depends on who your competition is in that market. When it's an oversaturated market, then of course you want to go out there, raise capital so you're able to compete with your competitors and scale quicker. Compared to, if you're competing in something where there is very little competition or challenges as far as you've got to navigate in your growth story, I think you can afford to sustain and avoid or resist external funding. I think Bougie is a great example of what he's doing, right? For those of you who are not from Bombay, I don't know how many you're not, but I find it very fascinating, the story of the founder who started Bougie Cafe and who consistently refuses to have any external funding because he's like, I'm not ready for it today. I don't need it, right? This is a business. I found a way to make it cash positive, to sustain it. I know what I want to do. When I'm ready for it and I know what I'm going to do with that sort of capital, I'll reach out. And on the other hand, we recently were a part of a transaction again in the hospitality sector, Bombay Canteen. And there the whole story is so different, right? The valuation was on the back of them also having a product. There's only one Bombay Canteen now. There's a certain prestige to the restaurant that they've built. And they ended up raising a massive round. You have Dishoom and the LVMH group that came into that ecosystem. So I think there's countless stories, but you usually, in my experience, I'm able to see it in two different buckets, where either it's for strategic growth partnership or I want that quick, big jump and scale because I'm ready for it now.
Extending the same point, what are the guardrails that promoters should ensure when they're becoming part of a larger platform, in your experience?
Oh, a bunch of things, but I think from a legal standpoint, liquidation preference. I know that's probably too much legalese, but many a times I notice promoters, founders just glossing over it or not fully realizing the consequences of what that legal provision actually means when you're looking at a liquidation event or one of your investors wants to see an exit. So I think just having clarity on that. The other one that I've learned from a lot of experience is reserved matters. And I know it sounds like almost a given or, but look, I'm going to have to let somebody else take control of XYZ. But this is actually more for the investors than for the founders. The reason you're investing is in something or in a promoter is because you find that person interesting. You're really betting on that founder. What's the charm in not letting them operate with their secret sauce? And when you're dealing with a lot of VCs or funds, you naturally don't have, you may or may not have market expertise or sector expertise. That's the reason why you've identified that business. So how about you let the founders have some control or some degree of meaningful decision-making power in what made the business successful or attractive to you in the first place. So I think those are the things that I truly sort of really get in there and support founders and promoters in negotiating and protecting really hard when we're in the midst of a raise.
I think a related question to this is valuation. Either of you can take it or both of you may want to share your views. I think valuation is an ever-moving goalpost, right? Depending on market, depending on liquidity positions at that point in time, et cetera, et cetera. In your experience, what are the things that kind of define a baseline valuation and allows entrepreneurs, bankers, everybody who's involved to sort of hold the ground? Anything above that is more market sort of defined, competitive tension defined. So what are those baseline things which kind of allows to hold the valuation on a negotiation table?
Ashish, if I have to say this, I think first of all, the structure or the base structure of an entity should be appropriate. Now, there is no one tax structure or legal structure which can fit for everyone or every entity. But there are certain fundamental rules which are universal and which every sort of entity can apply, whether it is a startup, whether it is an MNC, or whether it is a PE fund. And these fundamentals play a big role when it comes for valuation. I would say, first, choose your holding company or build your ownership structure appropriately on day one. Holding companies should be decided on day one and not later. Yes, there are instances whereby you have to move, but restructuring your holding companies at a later date could be very costly. These expenses really hurt. We would have seen PhonePe moving their holding structures from offshore to India and costing them more than $1 billion in India. Same has been the story for Grow, Razorpay, and I don't know how many more. The secondly, and this play a big role in your valuations, because if the holding is correct, the investors will have confidence, and it plays a very big role when you go to the valuer or when the value becomes substantial for an entity, it's successful. The second, I would say, put value in a jurisdiction when it comes to cross-border, more or less, and in a jurisdiction and in an entity which has genuinely created value. Being a tax professional and looking from a tax authority's eye, tax guys genuinely want to see decision-making people value appropriately where the profit is generated. That has been the case for Tiger Global as well, that they had good amount of profit being located in a jurisdiction like Mauritius when the Flipkart's shares were sold, but the decision-making, etc., was sitting somewhere else. And hence the tax guys were uncomfortable. So the value should be put in a jurisdiction and entity which is genuinely creating that. The third I would say is that keep your structure simple. No one likes complicated structures. Complex structures more or less delays exit, and it even impacts your valuation. Then it could be minor factors, I would say, but these are something which could be taken care of. One, your governance should be very robust. Build your governance standards from day one rather than waiting that the business grows and then we will build the structures or the governance, whether it is financial, legal, or tax. And lastly, I would say keep reviewing your structures as the business evolves. So there is nothing which says that one structure fits throughout the lifetime. As the business evolves, more investors step in, or you are into bit more markets, you expand yourself globally, the structures, whether it is legal, tax, etc., keep evolving. So these factors are very universal and which plays a big role when an entity is valued, when it is successful and it is being valued.
I'm going to add to that. My experience with valuation is fairly varied, and most of the times is directly proportional to whether or not the celebrity I'm representing is getting cancelled online, or what is the value that they enjoy today in the market. And there's all sorts of examples, right? Whether there is a Shraddha Kapoor and Palmonas, there's a Shilpa Shetty and Bastion, and sometimes we'd be working with, we'll end up working with a lot of private equity funds, for example, that look at the entertainment business music catalog, right? So the more legacy the catalog, the higher the valuation. We'll see 20, 25x multiples at times when we're looking at buying legacy assets. And there's a bunch of deals that have been announced publicly, whether it's the Bruce Springsteen catalog, it's Justin Bieber selling some of his publishing rights. And again, these are all serious, multi-million, billion-dollar transactions at times, but so much of the valuation or the valuation story stems directly either from the talent that is associated with it or what is happening in their life cycle, in that moment that makes this value go higher or sort of plateau out and fatigue. And look at something as recent as 1-8. Sure, it's yet another shoe brand, is the cynical way of looking at it. But the minute you add the star quotient of Virat Kohli, that valuation simply skyrockets, given what his equity is today, the position that he enjoys in the industry. On the other hand, sometimes we look at an interesting, either a consumer product or a business that is associated with talent, and God forbid there is Me Too, or they've cracked a horrible joke online, and before you know it, everyone just has this knee-jerk reaction. They're like, we want out, this is danger, I can't be associated with it. And so for me, the valuation story is an ever-evolving curve.
One last question before we open up for audience questions. Market timing versus fundamental strength of the business. What's your experience?
Sorry, market timing?
Market timing of exit versus fundamental strength of the business. Which is more important?
While raising a round?
No, while divesting to a strategic buyer.
Sorry, while
divesting to a strategic buyer.
While divesting to a strategic partner. So market timing versus fundamentals. Ooh, that's interesting. I don't know. Look, I think as advisor, I see both categories of clients. Some who are extremely strategic, very, very business savvy, and who understand that, look, I'm at an interesting stage in the life cycle of this business. I don't know what this is peak value. I see that in a lot of assets that we purchased, right? Recently, we ended up selling one of Bollywood's biggest paparazzi pages to a big media conglomerate. I mean, it's the first time in my career, at least of almost 20 years in the entertainment business, that I've seen a paparazzi page being acquired. Who knew? But here you are, and it was interesting timing, because just look at how much the media business has changed. So as far as this conversation was concerned, it was just purely looking at market. But enough and more times, I think it's rare. So, but I very rarely will see some founder saying, no, I'm going to see this through. I'm going to keep building. So I think my answer would be more market-based.
Amit, do you care to comment?
I would say both are equally important. There are times when we see market timing is much more important than anything else. Definitely, even if the market timing is important, the fundamentals of the business should also be there. But that also depends on the investor's eye and his future outlook. So if we see some of the IPL teams, if I may have to say, there was times when no one was looking at it. The teams were valued at around 500 crores or so when the initial investment happened. And that was the time when some of the investors had the eye, they had the future outlook towards this game, etc. And they entered. And today, we see the transactions going around maybe 100x of that. There were deals which happened recently, earlier or late last year, around 2 billion or so, if I have to categorize in dollar terms. So market timing is very important, but I would say market timing without fundamentals won't make sense. So even if I time it something, I have to look at what are the fundamentals in this business. Unless and until the fundamentals are good, even a person who has a good eye with regard to timing, he won't invest. So I would say they both reciprocate each other, and they both are equally important.